So problem 2, same as problem 1, except assume that the fair market value of Lime's building is $700,000 and that no money is owed by Lime. Also assume that there's a $100,000 liability associated with Lemon's building, which Lime assumes. Okay, so this problem continues with problem 1. Remember, I've given you the facts for problem 1 here, and there's also a video that goes over problem 1 in case you need to start with problem 1. The idea with this set of problem, the lemon-lime problem set, is that you should start with the earlier ones and then work your way through because it gets a little bit more difficult. You take the same facts you took from problem 1, again, that's right here, and the only thing we adjust is the information given to you in problem 2. So we're focusing again on non-recognition in this problem, specifically like-kind exchanges. Now, in problem 1, remember we're specifically told to focus on lemon, not lime. So that's what we're going to do. We're not going to worry about lime. Of course, you might have a problem where it does ask about lemon and lime, not here though. And I don't give you all the information to answer both parties. But lemon is who we're focusing on. Also in problem 1, it asks us to calculate the realized gain or loss, the recognized gain or loss, and the basis of the building received, which we went through in problem 1. What you see on the screen currently, starting out, we haven't written anything as we've gone to the problem yet, but we did start off with some stuff. And this format is the same format you saw in problem 1. Step 1, we calculate the realized gain or loss, right? Amount realized minus adjusted basis. Step 2, we determine how much of that is recognized and any special rules. And then finally, step 3 is the adjusted basis of the new building. Okay. So let's start with step 1, the realized gain or loss. Remember, any property transaction, doesn't matter whether it's a building or you're selling something for cash or it's intellectual property. Property is property, very broad. Any property transaction, sale or exchange or other disposition, we go through the realized gain or loss calculation. We start off amount realized. Remember, amount realized is actual cash received plus constructive cash received plus the fair market value of non-cash property received minus selling expenses. You'll note I don't have selling expenses on here, and that's because in this problem set, the non-recognition problem sets for like-kind exchanges, involuntary conversions, we don't have selling expenses, so we're just going to ignore that. But obviously in practice, if you have selling expenses, you subtract them from your amount realized. Okay, so we go to the amount realized calculation, and we're focusing on lemon. We're focusing on lemon again, not lime. So we first start off actual cash. Again, let's read 2, problem 2. Same as 1, except assume the fair market value of Lime's building is $700,000 and there's no liability owed by Lime on Lime's building. Also assume there's a $100,000 liability associated with Lemon's building, which Lime assumes. In problem 1, all that was going on in problem 1 was Lemon and Lime were trading buildings, but also Lemon was taking on Lime's liability, which now in problem 2, that liability is no longer. Now though, here, it's the opposite. Lemon has a liability on Lemon's building and Lime is taking it on. So it's the opposite of problem 1. So again, to review, what's going on in this problem? Putting together problem 1 and 2. Lemon is getting a building from Lime and also getting liability relief. And that's what the amount realized focuses on. Okay? So there's no actual cash, right? Actual cash here is 0. Constructive cash, we do have constructive cash, right? That's the liability relief. So there's a $100,000 liability relief associated with Lemon's building, which Lime assumes. That goes under constructive cash. Plus the fair market value of non-cash property. So whenever I do amount realized, I always stick first to determining the fair market value of the property received, the like-kind property received, which here, of course, is $700,000, the value of Lime's building. In the future, for future problems, that's always where we're going to start. So keep that in mind. So again, Lemon's getting just those two things. So Lemon's amount realized equals $800,000. Okay. Minus adjusted basis of property given up. So we're going to start with the adjusted basis of Lemon's building. We're not told anything in problem 2 about the adjusted basis of Lemon's building, but we are told in problem 1 it's $500,000. So we stick with that $500,000 because it did not change in problem 2. Is Lemon giving anything else up? Is Lemon giving Lime any actual cash? No. Is Lemon taking on any Lime's liabilities? In problem 1, Lemon was, but not problem 2, because the liability is no longer there. Lime does not owe money. So the constructive money to Lime is 0. So Lemon's adjusted basis of property given up is $500,000. And we have a realized gain of $300,000. Okay. Now we go to step 2. Step 2, we determine the recognized gain or loss. Remember in the tax law, the general rule is that all realized gains and losses are recognized unless there's some type of special non-recognition rule. Okay? So, at this point, the only non-recognition rule you should be thinking about is like-kind exchanges. Which, remember, for a like-kind exchange, you need to have an exchange of real property for real property that's held for business or investment on both sides. And remember, in problem 1, we're told that Lemon held the old building and getting the new building both for business. So Lemon qualifies for like-kind exchange non-recognition treatment. However, if we go to our amount realized chart and we have any actual or constructive or non-cash property that's not like-kind, received is the key, you've got boot. And you got to worry about boot. So in problem 1, we didn't have any boot received. We have boot paid, liabilities taken on, but no boot received. Problem 2, now you have, hey, $100,000 of constructive money received. So the rule is, it's the lesser of the realized gain we just calculated, right? $300,000. Or the net boot. Now, let me explain net boot idea. And we'll see this in problem 3 and problem 4 and problem 5 in more depth about netting boot. We're going to have to do that. But net boot simply means if you have boot received and boot paid, you might be able to offset one another to lower the amount of boot. But we do not have any boot paid here or transferred out. So what does that mean? That means that the boot received is simply just going to be the $100,000, right? And our net boot is $100,000. And the lesser of those two numbers, bam, of course, $100,000. So our recognized gain is not $300,000, it's $100,000. Let me erase this arrow because I don't want there to be confusion. I meant to bring that down here. It was more so meant to go here. There you go. All right. So we've got our recognized gain, $100,000. Now the third step is to calculate the adjusted basis of the new building. And you're looking at that going, okay, yes, I see. Step 1, step 2, step 3. However, remember that the way I'm teaching you this topic is I want you to ace it. I want you to make sure you got it 100% right. So one way that we do that is we're going to check our work. And the first way that we check our work is between step 1 and step 2. After you calculate the realized gain or loss in step 1 and the recognized gain or loss in step 2, you are going to calculate the suspended gain or loss. The suspended gain or loss, and we're going to do this in each like-kind exchange calculation. The suspended gain or loss is step 1, the answer to step 1, minus step 2. So step 1, of course, $300,000 minus step 2, we got a recognized gain of $100,000. Our suspended gain is $200,000. We have a suspended gain of $200,000. So notice the problem didn't ask us to calculate the suspended gain, but again, it's going to come in handy later on to help us verify, hey, did we get all the 3 items right? So it's a way to check our work. Okay, now we go to step 3. Step 3, calculate the adjusted basis of the new building. So we take the old adjusted basis, plus any money paid, minus money received, plus gain recognized, minus loss recognized. Now, before we actually go ahead and do that, I know you're all excited to go ahead and do that. Before we do that, I want to remind you, it's very, very, very rare to have a recognized loss in a like-kind exchange issue or like-kind exchange transaction. We're going to have like-kind property for like-kind property. We will see, though, in a later problem, so please stay tuned, watch the other videos. You will see later it's possible. And I'll just go ahead and tell you so you have an idea, but there's a problem later that goes over this. It's when you're giving up like-kind and non-like-kind property for like-kind property only, nothing else. Nothing else is in the problem. That's the only time you can have a loss recognized. And we'll see an example of that later on in problem 7. Okay, so let's go through this calculation of basis. So first thing, the old basis. So the basis of Lemon's old building is actually given to us in problem 1. But you can also find it here in our calculations. That's why I like to set up the calculation this way, because, hey, look, it's right here, the $500,000. So the old basis, $500,000, okay, plus money paid. So money paid, I like to come down to this line here, the adjusted basis line, actual money, constructive money, both are 0. So we have 0 monies paid, actual and constructive 0. What about money received? We've got $100,000 of constructive money received. No actual money received. We subtract that away. What about recognized gain? Yes, we've got $100,000 of recognized gain. So we add that. And again, it's very, very rare to have a recognized loss, so that will be 0. And in later problems, you're going to see, I'm pretty much just going to skip the recognized loss state until we come back to it in problem 7. So that will be just gone from the adjusted basis formula, but still keep that in mind. Okay, so we calculate our basis. 500,000 minus 100,000 is 400,000, plus 100,000 is 500,000. So our basis in the new building is $500,000. All right, we're not done. Yes, it looks like we're done. But we always want to make sure, again, we've done this correctly. So $500,000 new basis in the new building. We've answered all 3 questions, but the way we can check our work, we use our friendly suspended gain, right? We use this number here, the suspended gain or loss. We use that to check our work. How so? Hypothetically, this doesn't actually occur. We're going to assume we sell this new building for the fair market value, which we're told is $700,000 cash the next day. Ignore all liabilities. Minus the adjusted basis we just calculated, which is $500,000. That's this right here. Boom. We calculate this, right? Because if we're selling the building the next day, even hypothetically for cash, $700,000 cash, you got to calculate the realized gain or loss. Any sale, realized gain or loss on the property. Okay, so we calculate amount realized $700,000 minus $500,000 adjusted basis. That gives us a $200,000 realized gain. Anytime you sell for cash, straight cash, right, sale, always going to be recognized. So we have a $200,000 realized and recognized gain. What does that mean? Okay, that suspended gain of $200,000. Actually, you actually recorded it later on down the line, and the idea is that, remember, non-recognition is not an exclusion of gain or loss, it's a deferral. It pushes it to the future. So when you later sell it for cash, you have to recognize all $200,000, and you did. So that means that we've properly calculated this amount. All right, so that concludes this problem, and all of the issues related to problem 2. We'll go to the next one.